with the name of Allah. This is lecture number 9 in Management Accounting Principles for the third year Faculty of Commerce. In this lecture I will continue chapter 3, Capital Budgeting, Long Range Planning. The second method to evaluate project is net present value. The net present value of the proposed investment is the difference between the present value of the annual cash inflows and the present value of the required cash outflows. That means net present value equal the present value of the annual cash inflows minus the present value of the required cash outflows. Example 4. Network Service Center is considering purchasing a new computer network for $82,000. It will require additional working capital of $13,000. Its anticipated 8-year life will generate additional client revenue of $33,000 annually, with operating costs excluding depreciation of $15,000. At the end of 8 years, it will have a salvage value of $9,500 and return $5,000 in working capital. Taxes are not considered. Required. If the company has a required rate of return of 14%, what is the net present value of the proposed investment? Note: cumulative present value of $1 per annum or present value factor at discount rate 14% for 1 to 8 years is 4.639. Present value of $1 or present value factor at discount rate 14% at the end of 8 years is 0.351. Let us analyze the cash flows in this example. This company will purchase a computer network for $82,000. This amount is initial investment. The computer network will require additional working capital of $13,000. Also, $13,000 is initial investment. So the total initial investment in this example equal $82,000 plus $13,000 equal $99,000. This amount is cash outflows. The annual revenues $33,000 is cash inflows. The annual operating cost $15,000 is the cash outflows. Also, the company has a salvage value of $9,500. This amount is cash inflows, and return working capital $5,000 is cash outflows. Look at the years. Initial investment you will pay now, so there is 0 year. Annual revenue, you will get the annual revenue for 8 years. That means you will get in the first year, second to 8th year. Also, the annual operating costs you will pay from the first year to the 8th year. The salvage value, you will get the salvage value at the end of 8 years, and you will return working capital also at the end of 8 years. To get the net present value, you must calculate the present value of cash inflow and the present value of cash outflow. That needs present value factor. You can get the present value factor from the required. The company here has a rate of return 14%. The cumulative present value of $1 per annum at discount rate 14% for 1 to 8 years is 4.639. That means $1. If you get $1 from now to 8 years, that means the cumulative present value of $1 will not be $1, it will be $4.639. The present value of $1 at discount rate 14% at the end of 8 years is 0.351. That means $1 after 8 years will be $0.351. Look at the table. The initial investment 95,000, present value factor 1. That means you will pay the initial investment now. The $1 now equal $1. So the present value $1. The annual revenue, you will get the annual revenue for 8 years from now to 8 years. The cumulative present value of $1 will be $4.639. So you can calculate the present value of annual revenue by multiplying 33,000 times 4.639. The annual operating cost 15,000 times present value factor 4.639, and the salvage value 9,500. This amount you will get after 8 years. After 8 years, $1 will be less than $1, will be 0.351. The working capital 5,000 after 8 years will be less than 5,000 because the $1 after 8 years will be 0.351. You can get the cumulative present value from the present value table. Look at the 14% and 8 years. This number with the red color is 4.639. Also, the present value of $1 at discount rate 14% at the end of 8 years equal 0.351. This number in red color. The sum of present value of cash inflows minus the sum of present value of cash outflows equal net present value. In this example, the net present value is negative 6,408. That means this project is not profitable. By this lecture, you have skills to evaluate a project using payback period and net present value. Best wishes. See you later. Goodbye.